Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into another episode of the Money Insights Podcast. I'm your host, Christian Allen, and with me, as always, my good friend and co-host, who we lovingly know as Rod the Pod Zabriskie. Rod, what is up, my friend? How are things?
Hey, I am doing great. How about you?
I mean, I can't complain. And really, the truth is, if I complained, like, people would just get annoyed anyway. But yeah, I'm doing good. I have no complaints, other than maybe the weather, which is a little bit dreary. But I don't think anyone cares about what the weather in Salt Lake's like. It's also a little gloomy in these parts because of our brutal college football loss this last week. Maybe if we can get a win tomorrow, we'll get back on a happier note. But it's a little gloomy here, Rod. So that's maybe my only issue is just that, man, so close. You go in 2 years in a row, 9-0 last year, dropped 2 of the last 4, 8-0 this year. Well, now 8-1. So I don't know, man. I feel like they're pulling with our heartstrings in this one. So anyway, other than that, though, I'm good. And I know you love college football, so I thought we would chat about it. Anything going on in your life that's worthwhile to talk about, Rod?
Well, I'm always good looking for a good rebound game.
Game.
That's not
family, life.
Yeah, family's
money.
Good. And because of the topic today, I'll actually probably save some of the family stuff because it's going to be appropriate for today's topic.
Okay. All right. Well,
having kids who are in that realm of looking to become homeowners, this is right up.
Okay. Okay. So we're not going to have any Zabriskie family updates today. We're going to go straight into our topic.
Well, we'll get the updates in the topic. How's that?
That's even better. Yeah, that's what I meant to say. That was a better way to put it. Okay, so lucky us, we have a cliffhanger. If you want updates on Rod's kids and family, listen to the whole episode because he's going to sprinkle stuff in there. That's the teaser.
Yep.
I'm sure everybody is on the edge of their seats waiting, Rod. I'm certain of it.
Boom.
Okay, so today, Rod, we're talking about a hot topic because Trump recently threw out the idea of the 50-year mortgage.
Yep.
So not 20, not 30, not even 40. We're going straight to 50, Rod. So, okay, we can take this anywhere we want, right? Obviously, we've got an outline, but we're just going to roll with this. So I want to get your initial reaction, raw reaction from Rod when you saw the idea of like a 50-year mortgage, and then I'll give mine as well.
I mean, initially it's just to make it more affordable because almost everybody who buys a home buys it and knows that they can afford it based on the monthly payments, right?
Right. Well, and that's how everything is now, by the way, Rod.
Yep.
So phones, the phone companies are brilliant. You go to like the store. I was at the Verizon store. I had to get Canon a new phone just 2 days ago. We go in there and I noticed something really quickly. I've noticed it a few times, but they don't even list prices anymore. They just list your monthly payments on the plan. So like the phone doesn't even have a price. It just says, $20.99 per month, right?
Yep.
And so to your point, people buy cars, phones, houses on payments more than they do on actual price tags.
Yep. And so going back to your original question, initial response is, well, the big kind of concern for a lot of people over the last 3-4 years as interest rates went up was how on earth are these young people going to have an opportunity to get into a home?
Yeah. Okay. So you didn't look at this like this wasn't like a big like, whoa, this is terrible to you. That's not how it hit you.
Well, I'll say this. 30-year mortgage was the thing forever, right? 15 or 30.
Yeah.
And then a few years ago, they introduced the 40, and that was a little bit of a surprise. I was like, okay, well, that's
Okay,
longer
but
than
even the
30.
40 isn't prominent, right? Like it's still
No, yeah,
it's
it's
still like 30 is still kind of the standard.
yes. But
Okay.
then so then adding a 50 there, to me that just means most people won't ever pay off their house.
Yeah.
Because
Yeah,
even if I'm
there's no
30 years
question
old when
that's
I
true.
buy it,
I may or may not even live long enough to do that. But
right?
here's the other. Well, actually, I don't want to. I want to save some stuff. I just want to get kind of initial reactions. So my initial reaction, if I'm being totally honest, I was just like, of course. I was like, of course, there's a 50-year mortgage because why not? Right. Next, we're gonna bust out the 100-year mortgage.
Yeah.
So like, but here was my other thought after I kind of started like thinking through it in a little bit more detail. Um, Rod, we already have basically infinite timeline loans as it is, right? Like what is an arm or an in I mean obviously there's an interest rate with, but it's like meant to be a short-term thing where you're not paying off a lot of it until you get a balloon or something, you know what I mean? And then of
Yeah.
course people just jump. Then we have interest only loans. Like these are basically 100-year loans or infinite loans.
Yeah.
So in a lot of ways, when I kind of took that step back, I'm like, is it really that different than some of those other things? But I want to set the stage before we kind of dive into more of this nuanced stuff and just talk about some of the context around why, at least why I see the 50-year mortgage even coming out and being a potential thing, right? I
Okay.
can't read Trump's minds, but we can see some of the
Don't even
minds.
try.
He has multiple.
Oh, for sure. Yeah. At
They're multiple
least.
personalities.
Yeah.
Um, but but I think at the core, we've got to just understand kind of the context of what we're looking at. Okay, so a couple of things. Why does it exist? It exists because, to your point, there is very much an affordability crisis today. So the
Yeah.
average homeowner today, right? This is wild, absolutely wild. And this obviously varies by state and all those types of things. But the average homeowner doesn't get into a home until they're 40 now. Well,
Wow.
even like 12 years ago, it was like 29. So this number is going
Wow.
exponentially higher and
Yeah.
and relatively quickly. So
Yep.
again, for people who are in a house and they're like, "Oh, I can't believe they're, judging this idea of a 50-year mortgage." And maybe it's still okay to judge, but like just know that a lot of people that want to be in houses aren't in houses and may or may not ever find a way to get there, right?
Mhm.
So the idea here is that there's a more stable way to do it than using like an interest only loan. And other thing, the interest only and arms and stuff typically take like, you know, better credit, like more like a higher level of credit worthiness. And so a lot of people can't qualify on those types of loans. And so they're really dealing with your 15 or 30 for the most part.
Mhm.
So anyway, it's just important to note that despite this like idea coming in where it just feels like 50 years, really, like what next? People are struggling as a whole within the country to get in to homes, especially younger families. And so that's an
Mhm.
important element. And why? Well, there's a huge disconnect between prices of homes and wages, just like there is in healthcare, right? These things go up, but our wages don't keep up with it or haven't kept up with it. And so it becomes more and more difficult for people making still good money, right? Even
Mhm.
like I'm sure there's even high income earners out there who are struggling to get into a home and making a couple $100,000. I mean, if you're making 5, 6, 7, a million, you're probably not struggling to get into a house, but
Sure.
you still could be even as a relatively high income earner. And I think that's important. Um, Another kind of context to keep in mind is that currently 80% of mortgages are held at less than a 4% interest rate.
Yeah.
That's pretty wild, right? So everybody's holding on to that. They're like, I can't let it go. I'm in the same boat. So my house that I'm currently in is under 4%. I think it's like 3.25 or something like that. And I'm thinking, man, do I sell the house? Because obviously we're building the new one and 4 to 6 months out, we should be in it. But like, do I sell it? Do I just keep it and rent it? It's got such a good interest rate
Yeah.
that I'm almost certain that we could create immediate cash flow. So, not almost, I'm
Yeah.
certain that we could, right? So anyway, it's an interesting situation. And of course, part of the idea behind a 50-year mortgage is to like tap into some of the equity and stuff that's out there.
So
And
really quickly before we
currently,
leave that one,
yeah,
I remember, so I was really young back in the day when in the early 80s when interest rates just really skyrocketed. And so you
yeah,
had people similar to what you're talking about now. Felt like they were trapped in their home because they had a 6% interest rate mortgage, and if they moved, then they would become a whatever
8 or 9
15%
or
or
10 or
12%.
12.
Yeah,
Yeah.
like, and so I remember hearing about that there was a lot of seller financing going on. I have this
Yeah.
6% mortgage rate, so if you're going to buy my home, I will. And I was young. I don't know the logistics. It'd be interesting to go back and look at it because there actually might be a market for that in the current environment to say, like in your situation, well, maybe you do decide to hang on to it, rent it. But if you were going to sell and the buyer could buy into your
Absolutely.
3%
Seller
interest rate.
financing is very much something that I would put on the table.
Yeah.
Yeah, that's a really good point. And
But
so
I think you have to have some kind of go between because anyway, I don't know that you want to become a lender per se, right? All individuals out there who want to kind of take advantage of this don't necessarily want to become the lender and become basically on the hook for whoever this buyer is going to be. So
yeah.
it has its
Yeah.
issues, but I think there probably is some way to facilitate something like that.
Well, and obviously when it's not a lot different than if I were doing like short-term loans to friends, family, that kind of thing, right? It's
Yeah.
like in a lot of ways I'm doing kind of the same things mechanically. I'm just doing it now inside the context of seller financing, right?
Mm-hmm.
So of course it's important to know when I do seller financing, part of the reason that I do that is because I can create potentially better specs,
Yep.
interest rate, payback, all of those things can be more advantageous for me as the lender in that situation because the buyer's getting the benefit of not having to go through an actual bank, right? So
Yeah.
anyway, there's
And
a lot of benefits to it. I think it's a good point.
especially when you go back to the idea of that people are buying based on the payment. If you can pass along that low interest rate, then you can get a better selling price, right?
Yeah. Yeah. Yeah,
So
good point. Okay, Rod. Next thing I want to hit on is kind of what the 50-year mortgage actually changes. Number one, we've talked about this, lower monthly payments. That's key. I'm not saying lower home prices because it's not going to do that.
right.
It will certainly create lower. We know why, right? If you spread it out, obviously that makes it a little bit lower. Although I always think this, Rod. I always look at these loans like the 15 to the 30, and I'm sure this will be the same in the 30 to the 50. And I'm surprised that it doesn't lower payments more some of the time, right?
Mm-hmm.
It's
Mm-hmm.
not like it's exactly proportional like you might think of. It lowers it, but you still have to kind of look at it and weigh the pros and cons of that.
Yep.
Let's see. More people qualify. Demand increases, which means what? Means prices
Prices.
will likely go up.
Yep.
So again, one of those maybe intended or unintended consequences is while we're getting more affordability from a payment standpoint, we may actually be creating a situation where we're likely to pay more for the actual property. And
Yeah.
so again, there's pros and cons. So from your perspective, Rod, why does a long-term like 50-year mortgage potentially drive up prices?
Well, it's supply and demand. So if given the same supply, if supply isn't increasing dramatically, but demand is, well, prices have to go higher. It just does.
Yeah.
So and already when you look at the statistics and they talk about we're already have a shortage of supply, and that's projected to just get worse and worse as population ages, increases, like just the different dynamics of what the population will do over the next 10 to 15 years. And they project out and they say, well, in 2040 we're going to have a even larger supply issue. So if you artificially make this kind of change and that increases demand, well, prices are going to spike. It just seems
That's
inevitable.
just the way it works. Okay. Let's talk about the pros and cons. right? Because we're going to try to take a balanced view of this. I knew my initial reaction was kind of like mild shock, but like not like it was shock in the sense that it was like, wow, that's a long time, but it was also kind of like a not surprised. So kind of both sides of it, right?
Yep.
But I want to make sure that we take a balanced look at this, because I don't think that a 50-year mortgage is innately or inherently good or bad, right? I just think it's another tool that I can potentially use successfully. I could also use it unsuccessfully. So a lot of it is going to be about my behavior and how I interact with that type of mortgage. And just like an interest-only mortgage, it can be a really painful, bad idea in situations. I remember, this is an ARM one, but I remember early in my career, going to a home and going through like kind of the typical needs analysis that traditional advisors do when they get in there. And they were making like a solid income, but they had moved to an ARM, and they were like 8 months. They didn't even realize it. They were like 6-8 months from it boosting up. And we're going through it, and they realized that when that changed over, they no longer would be able to meet their monthly payments across the board, right? And well, that's obviously a difficult thing. So regardless, now the nice thing here is that you're getting that lower monthly payment, but it is actually locked in. So for somebody like that who, was working off of monthly payments, but you at least avoid the possibility of that balloon payment, which, could completely derail you if you're not prepared. Let's say that you're not in a position to get a new loan for whatever reason. Suddenly you get this, balloon payment that's due, you can't pay it, and now you don't have a house anymore, and whatever equity was there, no longer. So this at least smooths out the stability around those lower payments. So anyway, somebody like that would have really benefited being in something like this, rather than, potentially having something that could blow up on them. So that's just one thought that comes to my mind.
Yeah, it makes me wonder too, is if you go to that, it feels like that some of the kind of ARM adjustable rate mortgage side of things would shift as well. And so potentially but maybe not, right? Just think about 50 years. To your earlier point, maybe it's not going to be as low as you would think. But it sure has to make a difference.
I'm certain it does. You're putting on an addition. It's literally 60% more.
Yeah.
So there should certainly be an impact on. And we do see when you go from 15 to 30, like there's obviously an impact. And anyway, okay, let's talk about the pros though. Number one, Rod, it improves affordability at the monthly level, right?
Yep,
Now
definitely does
more
that.
people can get in. Younger people who are just starting their careers have a better opportunity to get in a home earlier, rather than having to save up and wait till they're 42. And if you go with the Dave Ramsey method, where you got to save up the whole amount, you're just not going to get there ever.
Yeah.
So the 50-year mortgage does absolutely create more affordability for people. It also will help renters become owners, right?
Yep.
And obviously, so this one is big too. Now, I don't think, again, I don't inherently think renting or owning one's necessarily better than the other. It always depends on the situation. But for a lot of people, that home ownership ends up being one of the places that they can gain significant equity and start to build wealth in some way. Even if it's just in their home, that's still something that's real, that's tangible, that people can get to, and then they can do more with it. And so from that standpoint, like to the extent I can get into a home and start developing real equity, again, situation is the boss. But assuming that it makes sense to do that, then that's a really powerful benefit that I get, because obviously if I'm renting, that's never going to happen. So I want to keep that in mind.
Sure.
Stabilizes cost of living. So let's low rate homeowners move, right? So that's another kind of situation where there's so much equity trapped in the market. Part of the idea is, how do we untrap, I don't know what the right word is, some of that equity. There's a massive amount of equity. I think it was like, I'm trying to decide if I have the number here somewhere.
Yeah,
It's something
34
crazy.
trillion.
34 trillion, like the size of the entire market, right? It's like absolutely nuts how much wealth is sitting inside of homeowner equity. So that helps to get it out. It'll unfreeze the housing market. Okay, that's what I already talked about. Unlocks trapped equity, we've talked about. Frees up cash flow so that I can do more investing, more savings, those types of things. So again, if I'm that person who has been like, maybe they're at a place where they're able to make their monthly payments and they're fine there, but they're just not able to get ahead. And from a savings perspective, something like this obviously could help do that, simply because now I have less money going toward housing. And I think that probably are the pros. Is there any other like positive, good things that you could see coming out of the 50-year mortgage?
One of the things that it's true of the 30, and so maybe it's not necessarily much different, but just this idea that when I establish my payment today, well, after 5 years, hopefully, chances are my income is higher. Chances are the value of the home is now bigger. And so relatively speaking, to the value, to my income, my payment is lower, right?
Yeah.
Right.
Yeah.
I'm
And it's like descending. You're creating a larger gap between those numbers, right? Things are going
yes.
up, and that creates this in between, this equity now that I can go and do stuff with.
Yeah. But I just have to remember that the equity that I'm gaining really is because the market is changing. If I have a 50-year mortgage, I'm not paying off much principal on the loan.
Yeah.
For
right. It's
for
slow.
decades, right?
Yep.
So
yeah,
but,
absolutely important to know.
That time difference does make a huge difference. Just the idea of appreciating values, anyway, and inflation on the whole kind of works in our favor in that situation.
Okay, I think that's a good point, Rod. So let's we've talked about like some of the positive things that could come out of it. Let's talk about some of the not so positive things that could come out of it. So this one is obvious because it's converse to what we've been saying, but higher long-term prices due to what you talked about earlier, increased demand. Now that I have more people can get in it, the demand goes up, and that simply drives prices higher. So again, we're already like struggling with the incredible increase in costs of everything, but certainly housing being one of those. And this is likely to just continue that with, again, payments lower, prices higher. Payments lower, prices higher. That's kind of how I have to think about it.
And so in that sense, it feels like it solves a problem today, but long term, you're just pushing it down the road. The problem becomes a problem again later. And then what do you do?
Could.
Right? Can you solve it again? I don't know if you can. It's kind of like when, 10 years ago, interest rates were low and they were already really low. And so anytime any kind of hiccup happened in the economy and the Fed's like, well, we can't lower rates any lower than zero.
Right.
So
That's
how do
it.
we use this tool that we traditionally used? Well, we can't because it doesn't. So I feel like it solves a problem, but maybe you just later on down the road, you run out of the ability to continue solving the problem with the same tool.
Yeah. That's a good point. Good point. One of the other cons, Rod, is that renters could get squeezed.
Yeah.
Is that what does that mean, Rod? That renters can just affordability becomes too challenging?
Yeah, because it's today the renters are better off because if the property can be purchased for lower, then I don't have to charge as much. I can, like, just from a pure accounting standpoint, I can take in less rental income and be great, still cover the mortgage. So for now, I think it does okay, but the getting squeezed part is just like, oh, well, it just becomes an issue again later on down the road. And so where they felt like, oh, because here's the thing, a lot of people, like you said earlier, want to be renters, and generationally, millennials, many more
Are more
millennials
likely.
want to be renters rather than homeowners because they're more mobile. They want to be on the run. They want to be more free to go and do, whatever the stuff that they do. And so they're they're living their life as renters. They're kind of at the mercy of what happens in that market. And so it could become problematic for them in the long
Yeah.
run.
Another issue, Rod, is that some buyers could find themselves getting overextended over time. Why? Because again, like there's good and bad with the whole shop based on payment, right? Like it ends up being one of those things that's kind of like fool's gold for people often, right?
Yeah.
Because I can afford it at this moment, it makes sense to purchase, I can afford it, but like I can afford the payment, therefore I can afford the house, or I can afford the item. And it's probably not always that simple, right? Just because I can afford a monthly payment on something does not mean that I could actually afford, or that it makes good financial sense necessarily to go
Yeah.
out and do that, right? And we see it again, phones, cars, houses, you name it, right? All of that. You can
Boats,
basically
play
finance
toys.
anything. You
Yeah.
can finance food, Rod. So on Amazon, I order my overnight oats on Amazon in these big old boxes, and you can totally finance it like a
Like a payment
$50
plan.
purchase. They'll be like, okay, you can do this, or it's going to be $7.89 a month for 12 months or whatever. Like, you could basically finance everything. And the concern there is that if you finance everything, you might find that you're not actually living within your means, despite thinking that you are, right?
Yeah.
So that's a concern again. And that applies to everything. It's not just the 50-year mortgage. It's just that it's financing culture that applies to, I would say.
Yeah, I think it's a great point.
Another
Because
big con.
the
Go ahead.
easier you make it, the easier it is to put yourself in a pickle, right? Which is the whole point, right? The whole point is let's make it more affordable, make it easier for people to be able to get in, and yet there's that people on that margin, they are more vulnerable now.
Well, yeah, and there's danger in getting too close to that, right? I need to have a balance between what I'm spending and what I make.
Yeah.
Because things happen. I could have some situation where I lose a job, or it could be more serious disability, or things like illness. Any of these things can come up, and suddenly having a $200 arbitrage between what I spend and what I make is going to crush me, right? So again, we're preaching to the choir here, because the people that we meet with are primarily like wealth builders, which we're going to talk about here in a second. So that part of it's probably less of an issue, but just for the general public, like, that's an important issue. It's going to be harder to build wealth if I push up against my payment limits, I think is kind of okay, Rod. Investors could flood the market. We're going to talk about investors more for just a couple minutes. So one of the cons, at least for people, is that investors could flood the market. Well, that also means that for investors, that's a pro. So, Rod, why would investors potentially flood the market based on this extended timeline that they could use? What would make them feel like, okay, now I can get in 50 years? I mean, it's the same thing, but describe why that happens.
Yeah, well, I mean, anytime you're going to buy a property with the idea that you're going to rent it out, you're just running the numbers.
Yep.
If I buy it at this price, and in this case, if I have if my monthly payment is whatever, $2,500 a month, and I can rent it out for $1,500 a month, that's $1,000 a month delta. And so that if I have, let's like $2,000 a month payment, but I'm renting it out for $2,500 a month. I have a $500 income, positive.
Yes.
And so, but pushing it to that $2,000 a month payment is what makes that possible, because it's a $3,000 a month mortgage.
I can't do it, right?
And I can only rent it for $2,500. Doesn't work.
Yep. So it simply creates lower payments so that they have more potential to create that arbitrage, and potentially on properties that you wouldn't have been able to on a 30-year mortgage, right? Suddenly, a deal that on a 30-year mortgage is just a little bit lopsided might be, a few hundred, might be now creating a few $100s of cash flow. That's a big, big difference. And so if that's the case, then certainly it makes sense that investors are going to say there's more opportunity for us to purchase now. And of course, that's really good for investors, maybe not as good for just the regular home buyers, right? So that's important. Rod, what are the other, or when you think about this specifically for the investor community, though, kind of what comes to your mind? What do you see? And again, we've talked about it primarily from just an everybody standpoint, but if we're honing specifically in on investors, what is, from your perspective, the good and bad of the 50-year mortgage?
I mean, I don't see much bad about it. And here's the reason. We talk about cash flow. If I can create that cash flow, and I've fixed my outlay for that part of it for 50 years.
Secure.
In the meantime, rents are going to go up, the value is going to go up. So I mean, I don't see a downside. On the other side, I look from the, again, Trump's the one proposing it, from the government standpoint, to make this a possibility so that it's affordable. I don't think they're trying to make it more affordable for investors, right?
I don't
So they
think that's the goal, but
probably,
it will certainly be an unintended consequence.
yeah, again, if they make it available to them, and if
Okay,
lenders
that's
do,
another good point,
right?
right? But we don't. So let me back up. This isn't a thing yet, right?
Right.
This is an idea at this point. We don't know if and when it is actually going to happen and who it would specifically apply to, right? To your point, if it was just applying to people who are purchasing primary homes, residents they're living in, that will look very different than if it's open to everybody. So that's kind of a really important nuance that will, have a huge impact on the actual impact that the 50-year mortgage has.
Yeah.
So I think it's a great point. Okay, I think I agree with you. I don't see a lot of downside to it. Again, maybe the one downside that we've hit on is just that I might be still paying a higher price for the actual property. But again, if my payments are intact, it's a numbers game, right? I'm not worried about that as long as I'm creating the cash flow and I'm able to get the leverage that and a property that actually improves in value. And if those things are happening, then the actual price point I purchase it at isn't really critical, right?
Yeah.
It just needs to hit the numbers. It just needs to, the pro forma has to work. Okay, let's see. Did we talk about, we talked about it doesn't fix supply. It only changes the affordability math, right? We've gone through
Yep.
that. And then the other thing that's a con or something to be keeping in mind is that equity buildup, to your point earlier, is absolutely going to happen more slowly, right?
Mm-hmm.
It makes sense. And you think about the way that loans are structured, you pay all the interest, all that stuff happens in the first year, in the early years, and then you start to make, real strides as you get later into it. My guess is that same principle will apply, and except that it'll be more extreme, right?
Yeah.
So I might be paying into my house for 15 years and be like, okay, I've been paying in for a long time, and go look at my statement and realize that I don't have nearly as much equity in it as I feel like I should.
Mm-hmm.
Right. And of course, the long-term consequences, that the long-term amount of money interest I'm paying for that is going to feel like much bigger. It's going to be much bigger. Right.
Yeah.
Now, again, if the payments work on it, it could still be valuable, but that's just something that I have to be kind of keeping in mind.
Yeah, but think of it this way. Let's go back to a 2008 scenario where values were driven up by something different, but it created a bubble. And when that bubble burst, your home, as an example, you were now underwater. Like, you either had to stay in that home or pony up if you ever were gonna sell
absolutely.
it before the values corrected. This creates a potential bubble that and spreads it out, like makes it much longer. So recreate that scenario, and you could have been in a situation where it would have taken 10 to 15 years to get out from under the being underwater, as opposed to the probably 4 or 5 years that it was in reality.
That's
right?
a good point. It's depressing to think about, and it's something we have to be aware of at the very least, right? Because if values end up going underwater, you could just end up stuck for a long period of time, right? Difficult to get out of.
Yep.
Yeah, really good point. Okay, so I hit on this earlier, but the way I'm really looking at this, and at least the way that my brain processes this, is to think it's not all that different than any other loan tool that we have, in the sense that, well, okay, so here's the deal. People don't hold on to their mortgages for the time frame anyway, right? The
Right.
average person, I think it's like 6 or 7 years. I can't remember the average, but I've read this recently, and it's like so there's many changes of my mortgage over my life. People move, people take out equity for projects, people do a variety of different things. Very few of them just sit on a 30-year schedule and just pay it.
Yep.
And guess what? The exact same thing will apply here. There'll be, people looking to use it as a tool. Most people aren't just going to be like, okay, I've got my 50-year mortgage locked in. I never plan to touch it until I'm 80, right? It's just, we're just going to pay it off. So again, when I think about that and I think about interest only loans and ARMs and things like that, in my mind, it just acts as another tool, right? Those are kind of forever loans. This is a little bit more of a stable forever. Obviously, it's not forever, but it's a incredibly long-term loan,
Fixed.
but
Yeah.
it does stabilize it. And that's important, right? Because again, we've talked about this. I don't suddenly end up with this balloon that could throw me completely off the rails from a financial standpoint. But that's kind of the way that I process this. Is it took me a second to just kind of go through the different scenarios. But once I kind of got in my head, Rod, this idea that, well, we kind of just already do that stuff, right? Then that's when it started to kind of click in that, okay, at the core, this is going to be valuable to some people. It's not going to be valuable to others. And it really depends on how I use the actual tool that's available to me. It's less about whether it's good or bad.
Yeah.
It's about how we as individuals use it, because it could absolutely be good or bad for us.
Yeah, I totally agree.
Okay, Rod. So let's talk about the winners and losers, should we?
Yeah.
Winners and losers. Who wins? The winners, first-time home buyers, right? People who don't want to wait till they're 40 to get in a mortgage or to get into a home. Maybe they have an opportunity to get there 10 years faster. That is absolutely a huge win, because not only are they getting into the home, but they're also moving to a place where they're building equity and building wealth. For a lot of people, their home is like their biggest equity asset, right? And in a lot of ways, it's beneficial because it's forced savings. So anyway, when I get into that space, that's positive. So absolutely winners. We talked about this before, but investors would be big time winners, to your point, because now I'm getting in at a lower monthly payment with more stability. And then the other ones would be like those homeowners who are currently rate locked, right? Because obviously it's now, that doesn't mean it's necessarily wise for everybody to be like, hey, I can go 50 years now, so I should jump out of my 3% mortgage. But it gives people a little bit more optionality, right? Because that really low interest rate drove the price down.
Yep.
Right? Now I'm trying to go get into the exact same house that I'm in today or something similar, but I'm paying 20% more because interest rates aren't at 4%. They're at, 6%.
Yeah.
Or, I don't know what the exact payment looks like it, but still, that's kind of the principle. I'm going to be paying a higher amount for that. Okay. So any other winners, Rod, that you can think of? Do we catch all the winners from this?
I think so.
All right. Who are the losers?
I mean, losers are the future in me, the biggest loser is the future buyers, that you've solved the problem, but it's a temporary fix. The market adjusts, prices adjust. Pretty soon, in who knows how long it takes, 5 years, 10 years, prices have now increased to the point where, yeah, you almost have to get the 50. You can't afford to choose the 30-year option because all the pricing has adjusted to that kind of change that was made.
Yeah, I agree. And, we've talked about renters being a challenge for that. But to your point, renters and future buyers are often the same. So it's like that grouping is going to be difficult. And then maybe the last potential loser is, I don't know if this is even a lose, but if it's not available to investors, then obviously they're not a winner. I don't know if you'd call them a loser in that situation,
Yeah.
but they're not winners, right?
Well, maybe we could say this though. If there is a mechanism in the market that's forcing prices higher that investors can't participate in, they're losers in the sense that the prices got driven up, but it still didn't make any sense for them to buy the property when it was a 30
Yeah.
or 20 or 30, however the lenders, will offer it. Well, as prices go higher, it's certainly not going to get any better. So getting
Yeah.
into new properties moving forward might be a challenge as the prices go higher.
Yeah. Okay, Rod. So you teased us a little. I'm not going to let you off the hook.
Okay.
So you've got kids who are now grown. They're going to be in this stage where they're buying homes. When you think about your kids and the 50-year mortgage, what goes through your mind, whether good, bad, ugly, or somewhere in between?
Yeah. So it's been an interesting thing because our oldest, they graduated from, she and her husband graduated from college, got kind of the regular stable paying job. Were ready to purchase as interest rates were going higher. So they were right on the front end of that. But they didn't want to just sit around and see what was going to happen. So they jumped on it and got a decent rate as it relates to where they have been. So it was, I think it was like maybe spring of 23 or something when they bought their home. And so it was certainly higher than it had been a year before then, but it wasn't as high as it ultimately got.
Okay. And how old is Julianne?
So she is now
You're old.
28.
Oh, wow. Gosh, time goes fast, man.
Turning 28.
I remember when we came over to
27.
dinner and she was excited to show us her bees.
Yeah.
Rod, it feels like not that long ago. It was only like 15 years ago.
Yeah, exactly. Yeah.
That's wild.
So
Okay,
yeah,
so
married,
yeah,
has 2 kids. Anyway, so but on the other side of that, to buy where they wanted to buy, which is in Utah on what we call the Wasatch Front, which pricing is a lot higher here than it is in other parts of the state and in other states. We have a lot of people who leave the state to get more affordable, housing
sad, Rod.
prices.
It used to be that everyone came here to get the affordable
Right.
housing. That's
Yep.
not quite the way it works. Now, maybe if you've got this power property in California, you still might do that, but it's a lot
That's
less
it.
prevalent today
That's one of the
than
reasons.
it has
Yeah.
been.
Yeah. So what they did is they bought a fixer upper, which was built in 1900, added to in like 1950. So they got what they wanted in terms of being able to get into a home. And then the flip side, they just had to know that they've done a lot of work on it, and they've done a good job. It's been really kind of a fun process for them to work through, but they knew
Okay,
going
so they
in,
bought a
they were
little
kind of
bit of a
settling.
fixer-upper.
Yeah.
Okay, cool. Good
Yep.
for them. Good for them.
Yep.
Have you been out there, like, pounding the hammer with them?
A little bit. Yeah. No, they've done most of it, but we've pitched in some and helped out. So it's been fun.
Awesome.
And then
Okay,
our
so
second,
uh-huh.
so Chase, he graduated from college last year.
Mhm.
And his initial job, they were renting. They weren't necessarily looking immediately to buy. But then recently he had a job change, moved back kind of closer here. And so they did end up buying, but they bought a townhouse,
Yeah.
which it's crazy. And I don't know what they paid for it, but the same size of townhouse today costs twice as much as it did, maybe 2.5 times as much as it did 3-4 years ago.
Mhm.
It's
wild.
just been crazy. Again, especially if you're breaking it back into the monthly payment. So the
Yeah.
interest rates happened, but also the prices just went crazy over the last
Skyrocketed.
5 years.
Yeah.
And but so again, grateful they were able to get into something. It's not the kind of thing that has a big yard or anything like that, right?
Right.
That they, I think
Well,
they ultimately would like to
sometimes
have, but
people don't want that, but
yeah, right. There are
it's
clearly a lot of
theirs,
people.
right?
Yep, exactly. So they did it. And then the third example, our son Spencer, who's in the Army, he re-upped, so he's in El Paso and will be there for at least another couple of years. So they're looking at buying now, and they have the benefit of being, because he's military, then there's the VA loan. There are other things that they can do without
Yeah.
having, they don't have to have as much of a down payment, et cetera. But I think about that in the context of the 50-year mortgage. And again, to the earlier point, the having these different layers of things that make it easier to get into the home. So your military, we want to make it easier for you, more affordable because of, this role that you're playing in our society. And then the 50 mortgage and some of these other things, making it so easy. But to your point, they wouldn't, even though they're planning to be in El Paso for another 2 to 3 years, still that nowhere near 50, so nowhere near 30, right? Nowhere near even 15. But the point is that they will likely be doing some buying and selling over time. And so as long as they don't kill you on the closing costs and all that other kind of thing, the front end costs, then having the 50-year mortgage will make it easier for that kind of situation.
Okay, I have a question for you, Rod. Putting you on the spot.
Okay.
You ready? Yes,
I'm ready.
You ready? Okay.
I'm
I
ready.
needed an audible response.
You didn't want to just assume.
No, this is important, Rod.
Okay.
Who dislikes the 50-year mortgage the most? So if you're now looking at the internet and you're like, okay, there's some outrage about this, who is outraged about this 50-year mortgage?
I would say people who, older folks, who have
more
this
traditional idea, that just feels like an uncomfortable,
Yeah.
like, hey, we're really going the wrong direction.
Yeah, because and the biggest reason I thought of them is because there's this traditional idea of the American dream, including home ownership. And home ownership not just meaning you live in a home that you're on the title for, but that you own it outright. You don't have any mortgage, any encumbrance on your ownership. And the fact is, I think we've been moving away from that ideal kind of scenario for a long time. And this is just another iteration of that. Because to your earlier point, most people, let's say it this way, most people who are maybe, 50 and under may not ever own their home anyway, even before the whole 50-year mortgage is introduced. And ultimately, if it goes through, we'll see. But because of what you talked about earlier, the buying and the selling, even if I'm on 30-year mortgages and I bought my last home when I was 60, well, I have to make it at least past 90 and make all those payments. But then, you think about how many people retirement becomes possible because of a reverse mortgage, right? So even if I was working toward that and could work towards that, but then I say, well, there's all this equity in my home, I want that to actually create some value for me in my later years. Well, I'm turning that around. I'm going to actually use some of that equity to be able to retire on anyway. So I just think the dynamics are a lot different now than they were, but ultimately that's why I thought of that group.
Yeah, that makes sense. So I'll add my 2 cents. When I think about who's going to hate this the most, I think Dave Ramsey, Susie, or the debt is bad people, right? The people who don't believe, like, obviously we talk about debt as a tool, and I always couch it by saying we have to use leverage conservatively and wisely, intelligently. But for the people who are wealth builders that believe debt is a tool, I don't think that they look at this as some big awful thing. It's just another tool within your arsenal to create that, right? But then you go onto the other side, those people who were like, debt's terrible, it's the source of all evil. And by the way, I get it. Debt, it can be crippling if you don't manage it appropriately, right? There's a big difference between good debt, investor type debt, and consumer debt. So this is kind of a little bit of a gray area when you're talking about a personal residence. It's maybe not as clean as like what we're talking about as an investor, but there's still value that is being created in the back end that makes it, still potentially powerful for people. But anyway, that was kind of my thought. The haters are going to be the debt is bad. I have 100% confidence. I wonder if I'll be wrong on this, but my confidence is at 100%. So we'll see that Dave Ramsey is going to be very much against the idea of the 50-year mortgage. I could be
I have
wrong,
to agree.
but that's my guess.
I have to agree.
All right. Okay, well, we decided to talk about this because obviously it's like a hot topic and it's interesting, and it certainly will, if it ends up going through, and especially for our community, if it's available to investors, it will almost certainly become a prominent tool used within the investor community, right?
Yeah.
Just because you're getting like some of the best of both worlds. You're getting that lower payment, but you're also getting some form of stability that I wouldn't get from like an interest-only loan or an adjustable rate mortgage.
Mhm.
So that ends up being kind of a powerful thing. And then of course, there's going to be those constant haters who are just like, stay away from this, hell or high water. You do not touch the 50-year mortgage, right?
Yeah.
That's kind of the way I see it happening.
Yep.
Okay. Well, Rod, do you have any final thoughts? Do you feel like we covered everything?
Yeah, I think it's been fun. I think it's been a good little mind exercise to think about.
Okay, if you're listening and you have any thoughts on the 50-year mortgage that we didn't touch on, shoot us an email, send me a message on LinkedIn or something. I would love to hear opinions about what other people think of it, because sometimes we miss some things. So I'm intrigued by what the community as a whole thinks of the 50-year mortgage. So reach out, let us know what you think of it, and thanks for listening today. Hopefully we will see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.